pull a dollar bill out of your pocket right now in your head and ask yourself a simple question. Why is this piece of paper worth anything at all? It's not backed by gold. It's not backed by silver. It's not backed by anything you could hold in your hand if you demanded it. And yet, you'll trade real hours of your life, real labor, real skill, for a stack of these things without a second thought. Hand it to a stranger behind a counter and walk away with groceries, as if nothing unusual just happened. Money is, when you actually stop and look at it, one of the strangest inventions in human history, a shared hallucination that somehow keeps the entire global economy running smoothly every single day. So let's trace it from the very beginning, because the story of how we got here, it explains almost everything about how the modern economy actually works. Before money existed in any form, humans traded through barter, direct exchange, your goods for my goods, likely stretching back tens of thousands of years. Long before anyone was writing anything down, barter sounds simple enough until you actually try to run an economy on it. Say you're a farmer with a surplus of wheat and you need shoes. For barter to work, you don't just need someone who makes shoes. You need someone who makes shoes and specifically wants wheat. At the exact moment you're trying to trade, economists call this the double coincidence of wants, and it's a genuinely massive bottleneck. Miss that coincidence, and your wheat starts rotting while you're still looking for a shoemaker who happens to be hungry for bread that particular week. So early societies solved this by inventing commodity money, items that had real independent value on their own, but that could also function as a medium of exchange. Cattle are considered among the oldest and most widespread forms of money in history, valuable across nearly every ancient economy that raised livestock, useful enough on their own that almost everyone was willing to accept them in trade. Salt, shells, beads, grain, all of these show up across different cultures as early commodity money because they solved barter's core problem. Instead of needing to find someone who specifically wanted your exact goods, you could trade your goods for something everyone agreed had value, then use that universally accepted item to get whatever you actually needed later. The catch was that commodity money still had real limitations. Grain spoiled, cattle needed to be fed and could die of disease before you ever got to spend them. None of it was easy to divide into small, precise amounts for smaller transactions. Try paying for a loaf of bread with exactly 1/10 of a cow. That's where metal enters the story, and specifically, where coins entered the story. The earliest known coins date back to around the 7th century BCE in the kingdom of Lydia, in what's now Turkey, made from an alloy of gold and silver called electrum, stamped with images that certified their weight and authenticity. So, merchants didn't have to test every single coin by hand. China was independently developing its own metal currency around the same era, using cast bronze pieces shaped like small farming tools, a completely separate invention, arriving at a remarkably similar solution on the other side of the world. What made coins genuinely revolutionary wasn't just that. They were made of valuable metal. It was standardization. A government-stamped coin told you exactly how much it weighed and, implicitly, how much it was worth, without you needing to weigh and assay a random chunk of gold every single time you wanted to buy something. This is also the point where governments enter the money story directly for the first time, because only a central authority could reliably guarantee that standardization. And once they could, they also gained enormous power over their economies by controlling exactly how that money got made. A power no government has ever fully given up since. Coins solved a lot, but they had their own problem. They were heavy, and moving large amounts of wealth meant physically hauling around a lot of metal. Not exactly practical for a merchant trying to travel between cities. With his life savings, paper money emerged to solve exactly that, first appearing in China as early as the 11th century, though for a long time it functioned less like the money we use today and more like a receipt, representing a claim on gold or silver actually held somewhere safe. Essentially, an early version of a banknote. This idea that a piece of paper could represent a promise to pay real value, rather than being valuable in itself, is called representative money, and it's the direct ancestor of paper currency as we know it today. By the time this system reached the modern era, it had evolved into what's known as the gold standard. Starting in the United States in 1879, an American citizen could, in theory, walk into a bank and redeem paper dollars for actual gold at a fixed rate of roughly $20.67 per ounce, a rate that held remarkably stable for decades. This mattered enormously because it meant a dollar's value wasn't just a government promise. It was tied directly to a physical asset the government couldn't simply create more of whenever it wanted, no matter how tempting that might be during a war or a recession. It was, in a very real sense, a check on unlimited money printing, one that would eventually become impossible to maintain as the demands on government spending grew far larger than the world's gold supply could keep pace with. And then, on August 15, 1971, that entire system ended. President Richard Nixon announced that the United States would suspend the direct convertibility of the dollar into gold. If you've watched our video on the petrodollar, you already know a huge part of the wider geopolitical story that followed this decision. How the United States pivoted almost immediately to anchor the dollar's global demand through oil instead of gold, and built an entirely new financial architecture around that arrangement. But focus for a moment on what this specific moment actually meant for the concept of money itself. For the first time in modern history on a global scale, the value of a dollar wasn't tied to a physical commodity at all. It became what's called fiat currency, money that has value purely because a government declares it does, and because enough people collectively agree to keep treating it that way. This is the part that genuinely unsettles people the first time they really sit with it. A modern dollar isn't backed by gold sitting in a vault. It isn't backed by anything you can touch. Its entire value rests on trust. Trust that the government issuing it will remain stable. Trust that other people will keep accepting it in exchange for real goods and services. And trust that the supply of it won't be expanded so recklessly that it becomes worthless. That collective trust is an incredibly powerful thing. Powerful enough to run the entire global economy, but it's also structurally more fragile than a system backed by a physical commodity, which is exactly why central banks like the Federal Reserve exist. Their entire job is managing that trust, primarily by controlling how much of the currency gets created and how expensive it is to borrow. Which brings us to a question most people have never actually had explained to them. Clearly, where does new money even come from? It's not contrary to popular imagination. Mostly printed on physical bills in a government facility. And physical cash actually makes up a surprisingly small slice of the total money supply in a modern economy. The vast majority of the money supply exists purely as digital numbers in bank accounts, and it gets created primarily through lending under a system called fractional reserve banking. When you deposit money into a bank, the bank doesn't lock all of it away waiting for you. It's required to keep only a fraction of that deposit on hand as reserves, and it lends the rest out to someone else, say for a mortgage or a business loan. That borrower then spends that money, which typically ends up deposited into another bank account at the same bank or a different one entirely, which then gets partially lent out again to yet another borrower who spends it, who deposits it again. Every single time this cycle repeats, new money is effectively created in the system, not printed, just multiplied through the act of lending itself. A process economists call the money multiplier effect. This is precisely why the total money supply in circulation is dramatically larger than the total physical cash that actually exists. And it's why a sudden loss of trust, everyone trying to withdraw their deposits from a bank at once, in what's called a bank run, can be so catastrophic to the entire system. The money genuinely isn't all sitting there. Most of it is already out working somewhere else in the economy, tied up in someone else's mortgage payment, someone else's small business loan, someone else's car financing. Central banks influence this entire system primarily through interest rates. And understanding this lever is really understanding how modern monetary policy works in practice. Raise the cost of borrowing, and lending slows down almost immediately, because businesses and individuals become more hesitant to take on debt when it costs more to service. That slows down how quickly new money gets created through the lending cycle we just walked through, typically cooling off an overheating economy or fighting inflation when prices are climbing too fast. Lower rates and borrowing becomes cheaper and more attractive, encouraging more lending, more spending, more hiring, and more overall economic activity. Though also, if pushed too far or held too low for too long, more inflation down the line, as more money chases the same amount of goods and services. This is the lever central banks pull constantly, meeting regularly throughout the year specifically to decide whether to raise, lower, or hold rates steady, trying to balance an economy that's neither overheating nor stalling out, using nothing but the price of borrowed money itself as the primary tool. So where does this leave us today? We've gone from cattle and salt to standardized metal coins stamped by ancient kingdoms, to paper receipts backed by gold sitting in a vault somewhere, to a currency backed by nothing but collective trust and government policy, to a system where the overwhelming majority of money isn't physical at all, but simply exists as entries in a digital ledger, created and destroyed constantly through the act of borrowing and repaying billions of times a day across millions of banks and accounts, without most people ever thinking about the mechanism running quietly underneath their own paycheck. And now we're watching the next chapter of this same story unfold in real time, with cryptocurrencies proposing an entirely different model. Currency created and verified not by a central government at all, but by a decentralized network of computers running open, publicly verifiable code with a fixed, mathematically guaranteed supply that no single institution can expand at will the way a central bank can with a fiat currency. Whether that ends up being a genuine evolution in what money can be, solving problems the fiat system has carried since 1971, or simply a new speculative asset riding alongside the traditional system without ever truly replacing it, is still an open question nobody can answer with certainty yet. And it's worth remembering that plenty of previous forms of money looked similarly uncertain in their earliest years, too. Here's what ties this entire 5,000-year story together. From a farmer trading wheat for shoes in the ancient world to a fractional reserve banking system creating money. Through digital lending today, money has never actually been about the object itself. Whether that object is a cow, a gold coin, a paper bill, or a number in a database, it has always, at every single stage of this story, been about trust, a shared collective agreement that this particular thing represents value, and that other people will keep honoring that agreement tomorrow, and the day after that, indefinitely. Without anyone needing to sign a formal contract guaranteeing it, the dollar in your pocket isn't valuable because of the paper it's printed on. It's valuable because, right now, today, enough people around you still believe it is, and that belief, as strange and almost fragile as it sounds when you say it out loud, is the entire foundation the modern global economy is quietly built on top of. If you want to see exactly how the United States built the entire global system to protect that belief after gold left the picture, go watch our petrodollar video next. And subscribe if you want more of these deep dives into how the systems around us actually work.